If you've got 70 trillion of debt to refinance every year, you need balance sheet capacity to do that. And balance sheet capacity is a measure of liquidity. And so liquidity is the paramount factor in markets now. In a world of capital spending, sure, interest rates are relevant, but in a world of huge debt refinancing, what you've got to do is essentially get the capacity, and that is all about liquidity.
It seems that everybody in the world reset all interest rates in 2009, and we seem to be at a 3.5-year refi cycle. Can you talk us through your thinking around this? Because this is, I think, a lot of people don't understand this yet, and I think it's really crucial.
Yeah, I think you make an extremely good point. And let me try and start off with how we think about things. The first thing to say is if you pick up a textbook, whether it's a finance or an economics textbook, what they say is interest rates are the paramount factor to look at, okay? Now, in a world where you've got a lot of capital spending going on, and you've got to compare a cost of capital with a return on capital, I'll come quietly and say interest rates matter. But that's not the world we're in anymore. We're in a world where there's huge amounts of debt refinancing going on. $350 trillion of debt worldwide, with an average maturity of around 5 years, means you've got to roll over something like 70 trillion of debt every year. Now, it doesn't matter so much what the interest rate is. I mean, clearly it's important, but that's not the critical point. Think of it in terms of a home mortgage. If you need to roll forward your home mortgage, refinance your home mortgage, it's not the interest rate that really matters to you that much. It's whether you get the roll. Because if you don't get the roll, you're homeless, right? And the same with a corporate. If you don't get the roll on your debt, you default. So it's the roll that's important. If you've got 70 trillion of debt to refinance every year, you need balance sheet capacity to do that. And balance sheet capacity is a measure of liquidity. And so liquidity is the paramount factor in markets now. In a world of capital spending, sure, interest rates are relevant, but in a world of huge debt refinancing, what you've got to do is essentially get the capacity, and that is all about liquidity. If you do the math and you look at it in terms of, let's quantify this, for every $1 of new financing in terms of capital spending, you've got $7 that are transacting in financial markets today for debt refinancing. So a 7-to-1 ratio. That's why liquidity is so important. If you don't get that roll, if you can't refinance, you have a refinancing crisis. And most of the crises that you look at historically, whether it's be 2020, 2019, the current situation, 2008, 1997, they're all refinancing crises.
So one of the things I've also looked at is I've looked at a broader level and thought, okay, GDP is the primary driver. It's the revenue, everything that generates within the economy. So if I look at GDP growth, we can use the formula of productivity times, it's productivity, demographics, and probably debt growth are the three components of GDP. And demographics are bad, so it slows GDP. Productivity has been terrible because of the demographics, and that's been slowing GDP. So we had debt growth, and that seemed to have got to a point where we got to that 100% of GDP in debt by the government sector. Now, what's really interesting, this is what I want to really dig in with you about, is I started looking at this and realizing, well, if trend rate of GDP is like 1.75%, and interest rates, long-term interest rates are somewhere around the same, there's still 100% of GDP that goes in paying the government debt. And then the private sector is another 120% of GDP, excluding the finance sector. So there's not enough GDP to pay the interest. So what I found out is that when I backed out the quantitative easing, I found out that it exactly matched the interest payments that were for the prior 3.5 years. And so it seems that the Fed balance sheet is being used to monetize those interest payments so it doesn't crowd out the private sector, which is creating this massive cyclicality that we're seeing from the liquidity cycle. I don't know, have you looked into some of this?
I haven't exactly, but it's what you're saying is extremely plausible. I think that's right. And what you're really saying is that a large part of the debt burden that we're facing every year is actually interest payments. And if the Federal Reserve is having to come in and actually buy that debt, then you can see a very strong correlation between the interest bill and effectively QE. And I think that's If that's true now, I can assure you it's going to be absolutely true in the future, because the way the government finances are working, it looks absolutely terrible, over the next 10, 20 years. Now, within that context, the US is bad, but the US is the cleanest shirt in the laundry here. Other countries are in a disastrous situation. And I think I picked up on, maybe it was listening to a Real Vision interview you were doing maybe a couple of weeks ago or something, where you're making the point about tech and AI, and that is the future. And, I go along with you, it is. But then you come back and you think, well, hang on, what are the implications of that for tax take? That's where it gets really scary, because what you've got is a situation where demographics are aging. Okay, we know that. Mandatory spending is skyrocketing. Just look at the Congressional Budget Office projections here. They're looking really bad in the next 10 years. Okay, they really start to zoom up. But then look at the tax take. The tax take is based on conventional assumptions, and the fiscal deficit gets big. But then if your thesis is correct, which I think it absolutely is, and you get this breakthrough in AI, you get job losses, how are you going to tax people in that environment? The tax base at the moment is squeezed dry. You can't raise tax rates anymore. The more you raise tax, people are going to go offshore, or they're going to find other ways of working. And so the government is in a real dilemma. They haven't thought through this AI dimension at all. And so the only thing you've got is you've got to have the central banks coming in and doing QE. That's the only thing that's there.
Yeah, because I think the technology drives the productivity part, not necessarily immediately, but over the next few years, I think we'll see productivity start to rise, particularly as some of the baby boomers, leave the kind of the demographics. But they're going to have to tax the robots, or they have to figure a new way of taxation. Because also, as we know, in this technology world, if we're not careful, it's going to accrue to some very, very gigantic firms. And they're going to have to think of some way of the tax take, because the human population can't pay the taxes. Just that they don't add up.
People are going to be disenfranchised from technology. They're not going to be earning in the same way as they had before. The tax structure just won't work. And so governments are going to have to rethink this whole thing. So it means you've got to do QE, which basically means that, reserve currency status in the world is going to be of paramount importance. And that's why the dollar is actually in a much, much better position than many people think.
Exactly right. So this is why liquidity is so important, because the system does not function without it anymore. Before it was one of the key drivers, it's now the key driver. When I put together our kind of liquidity metric, and if we use even just the G5 central bank balance sheets as a simple proxy for liquidity, not as sophisticated as some of yours, the S&P correlation is 97.5%.
Yeah.
Because liquidity is everything. And one of the ideas that I've got that people still dismiss is that this is actually debasement of currency. So you're actively, what you're doing is lowering the value of the denominator. Mm-hmm. The dollar is still king in all of this. People get confused because of currency versus the value of the purchasing power of fiat currency. But it seems that it values the denominator every time they use the balance sheets.
Exactly right. And I think the thing is you've got to then look at what I call monetary hedges to effectively to avoid the problem of governments debasing money. Now, gold is the traditional monetary hedge. I think one of the ways that people get muddled by this is they associate gold as being an inflation hedge, a high street inflation hedge. It's not. It's never been that. It's always been a monetary inflation hedge. It so happens that monetary inflation can feed into high street inflation, but that's not the starting point is monetary inflation. And the other is crypto. Now, if you combine, and I've probably shown you charts before, and I think in a pack I sent over, I've got that evidence. But if you look at what I call monetary hedges, look at the market cap of gold plus the market cap of all crypto, that moves with liquidity almost 1-for-1. Okay, so if you're going to get this process of QE, what you'll see are monetary hedges zooming in the next few years, and that means gold, and it means crypto. Now, the sort of the spooky corollary to that is that last time this happened, when you saw serious threat to paper money systems in the 1930s, gold was banned by the US. in 1933 or 1934, if I remember my history. And that's one of the dangers you've got in the current space. Are they going to try and find ways of actually stopping investors putting money into crypto or these monetary hedges? I would think it's probably too difficult now.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.